Good morning, everyone, and thank you for joining us for the PMA-CIBC Summit Series. Thank you to everyone in the audience today and in the industry for such strong support to keep our program fresh with new topics and discussions each and every month. My name is Chris Markovic from PMA Brethour. Before we get started with our program, we acknowledge the land that we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. We're grateful to have the opportunity to work on this land, and by doing so, we give our respect to its first inhabitants. And because our audience is national, if you are joining us from outside of the Toronto area, I encourage you to learn more about the traditional territories where you live, learn, and work. So it's timely today that we are having an in-depth discussion on the MQR, or the mortgage qualifying rate. And right now the 5-year discounted rate posted this morning at CIBC is 5.54 plus that 2%. Today we have some industry experts with us to kick us off on this topic. We know that yesterday I was at the Economic Club for a luncheon with Peter Rutledge, hoping to get some whisper of bright spot and good news. Looks like it might be a little bit more of the same for a little bit longer. But before we get into it, Andy, can you give us a short update on the market, where we are since we last were all together? And then I think, Pauline, you're also going to bring us up to speed with a little bit more detail. So Andy, go ahead.
Thank you very much, Chris. Delighted to be with you all today. Just a beautiful spring day this morning, and go Leafs go. We got another shot at it Saturday night. We are in full-blown recovery mode at the moment. How powerful is that a statement, given the last really almost year of adjustment that we've gone through? I think of it more as a year look back and a year look forward. And that in the spring of 24, we're probably back to much even more normal, let me call it, levels of absorption. Right now, I would call it an adjustment period after 6 or 8 months of strong stability, both in absorption from the resale market and in rates. It remained relatively calm. Even though we've seen little movements, it's been much calmer. And of course, the signal from a month ago on April 12th was not another bump in rates, but to remain where it is. The consumer reacted to that almost immediately. The March figures for resale were outstanding. I mean, it came back to nearly 7,000 units absorption. Normal, a 10-year average is 7,700, so it's not far off that particular period. And in the new home market, adjusted prices and packaging from builders like Treasure and Aspen and Brookfield, Deco, Mattamy, Paradise, the list goes on, where adjusted product pricing launches just met with tremendous reaction. Metropia on the high-rise side and Markham with a tremendous success story at $1,200 a foot. And most of this product movement has been in the low-rise side, under $1 million, 700s in the small townhouse market, 900s in a townhouse, and in the low, just at $1 million for a small lot single. These are all new price adjustments that have actually met with tremendous reaction. The same thing happened in resale, where prices adjusted and the consumer came back. Now, the key factor is that supply remains exceptionally low, both in resale, existing housing stock, and of course, new. As a result, this very tight supply with very strong demand, almost pent-up demand at this moment, is causing a bit of a surge. And you're seeing some price movement back up again, not dramatic, but consistent. And we think this is going to be a bit of a blip here through April, May, and June, as the push of demand exceeds our ability to meet supply. And we just haven't been able to adjust that yet. It will adjust slowly. One of the key factors pulling back a little bit is that the first-time buyer is really impacted severely by the OFSI stress test, the MQR, the 2-point piling on of mortgage rates. Now, it may be a judgment call on the part of OFSI and the Bank of Canada and Department of Finance to say, well, we don't want to add to this push of demand, and that would for certain add some push to get the first-time buyer back in the marketplace. The fundamentals of the market are such that it needs to happen. That needs to happen. The first-time buyer is the engine of the overall housing growth market, so they have to be a participant. They're slowly getting back into the resale market condo. That condo market resale is now over 30%, 32, I think, percent of the overall market in the last month. And that's a reflection of an entry-level buyer getting back in, but he's held back tremendously by the stress test. And that's got to come off in order to get them back in. That's an affordability issue and an easy one to change. But I get it. I get why they're holding off. And it may be because, boy, we've continued with immigration levels at world record pace. Pauline will talk about that a little bit, I'm sure, in her address this morning. But there may be a good argument to pull back on the levels of immigration until supply gets a chance to take its breath and catch up a little bit. We're never going to catch up, frankly, in totality. It would take years. But in this moment in time of 500,000 new immigrants a year, 900,000 almost student visas across this country, you're pushing the demand side. It's causing rental rates to soar. It's pushing even those trying to seek rental accommodation. You're going to have some social ramifications of this in the period of this market right now going forward in the next several months. You're going to feel it where I just can't find a place to live. So all of this kind of revolves around both maybe a relook at immigration in the short term and also the relationship to the stress test. I think as we've seen the investor return to both low-rise and high-rise market in this last 60 days. If the packaging and the pricing is right, that's a good thing in that's eventually going to create greater rental stock. And we've seen certainly those moving with equity, in whether it's from a condo to a townhouse or from a single to another larger single or a different move out of the GTA, which has been powerful still. We've seen equity transfer occur, which has been very strong, where the stress test is less impactful. The Bank of Canada meets again with their announcement on June the 7th. If we get too hot, too frothy, we're likely to find that, in fact, the market will be a response from the Bank of Canada that, in fact, might be a condition where they may see to raise rates again. And that's still a fear or an underlying one. We can all hope that it doesn't happen. In the case of where we are and where we're going, demand continues to outstrip supply, as I mentioned. The critical adjustment period is right now through this recovery as it begins to take hold. Suspension of the stress test is really important in the long term to bring the market back to the consumer's choice, not a government infringed regulation. I'm going to stop there and turn it back to Chris and introduce our panel and move on with this program.
Great, Andy. Thank you. Before we jump right into the discussion, I would like to let our panel introduce themselves. We've got a great panel today. Winson Chan from Tridel, Vice President of Sales Development. Winson, you're not a stranger to this program. Pauline Lierman, again, a friend in the industry, a colleague for many years of us, and we're thrilled to have you here. And Jeremiah, joining us from Colliers, Private Capital Investment Group, Land and Building Sales. It's great to have you join us, Jeremiah. If you'd like, just go ahead, give us a quick little intro to each. If you can pass it along, we'll start with you, Jeremiah, then Pauline, then Winson.
Great to be here, Chris. Thanks again. My name is Jeremiah. I run the private capital group, and what we do effectively is we represent owners of buildings and land in the GTA area, as well as the Greater Golden Horseshoe area, as well as Montreal and Quebec, and we sell both land and buildings for these owners. So effectively, we're acting as an owner's advocate in creating the way to liquidity in the market.
Excellent. Pauline?
Hi, I'm Pauline Lierman, and I'm Vice President of Market Research at Zonda Urban. We're relatively new to the Greater Toronto market and we're taking on an expansion of our data services, but we're not quite so new to out west. We once used to be known as Urban Analytics out of the BC market. And fundamentally what we do is we track market research and advisory on multifamily products. So that's all types of forms of apartments, condo, and as well as rental and townhouse product across the GTHA.
That's excellent, Pauline. Thanks for joining us. And then Winson.
I'm Winson Chan, a Vice President of Sales Development for Tridel. I've been with Tridel for the past 28 years. Tridel is a name that everybody know. It's a Canada leader in creating condominium living. For the past 87 years, we built 87,000 homes, and along the way, we collect a lot of industry accolades. So thank you for the opportunity for Andy to let us share our view. Thank you.
Thanks to the three of you for joining us. Before we jump into the discussion, Pauline, could you give us a quick overview on the market? What are some of the key takeaways for our audience today? Speak a little bit maybe on the for sale side and on the PBR, purpose-built rental side. Okay.
I'm actually going to share my screen. So I have one key slide to share. So we're just in the process of everybody can see that. We're all green lighting on that. Yep. Great. So we've just released our Q1 2023 numbers. And I have to say, overall, it was a tough quarter from a historical perspective. We had 2,664 apartments and townhouses sell in the GTHA, 2,100 and change of condos, and about 519 townhouse product. It was down 72% from last year, and I was kind of not expecting that to happen because last year was just such an intense market in Q1, and that's not normal for a Q1 period. It's usually a little more, 3,500 to 4,500 range. That being said, about all of this numbers, there are green shoots in here. One, townhouses have increased in sales. As we've seen even in the last couple of weeks, more so on that point. And personally, just from looking at the data and what we're seeing ongoing in the market, that we're actually starting to see it kind of, I feel, has bottomed out, and that we're actually starting to kind of come up more in terms of demand. Apartment project sales-wise, a lot of it's a bit of a balancing act. So there's, as Andy was talking about, that end user, that first-time buyer, you can kind of tell that with some project launches that maybe had a little bit of a slower absorption rate coming out of the gate. And then there was some very good, strong, quick wins that sold over 70% of their units, but primarily to the investor market at this point. On the rental side, I'm going to show this, but we just had our numbers there. We have about 1.8% vacancy rate in the GTHA. It remains very tight on that end. That's for dedicated new purpose-built rental. And based on our numbers, probably if you wanted to get a new building at this point, you need about almost $3,200 in rent. And that's a lot to do with the product itself. It's a lot of downtown sites, it's out at the Well, it's in Midtown Toronto, there's projects there. And they tend to be very well built and spec'd and kind of going towards maybe a little more of a downsize or a professional aspect. So there is that gap there, albeit condo rents themselves have actually increased 11%. The last thing I kind of point out about the market overall is I kind of expect it to flatten in terms of rent growth. We're starting to see that ramp up in new completions. We had 5,700 and change actually completed during the first quarter. And I find that I would caution that's a bit of a mirage. So we're going to deliver a lot of product over the next 18 to 24 months. But after that, there's going to be a real fall off in supply. And that's where we're going to kind of fall back right to where we are now, personally. So just be mindful of where the trends are at this point.
It's really, really interesting. Thanks for that bit of perspective there, Pauline. I look at your chart and I look at where we were sitting in Q1 of 2020 and where we're sitting today, and there's very close parallels. Winson, from a 30,000-foot view, can you, for us, just outline the MQR or the mortgage qualifying rate or the stress test, just to remind just so we're all at the same level? And in your view, is it still relevant?
Well, to a certain point, I appreciate the existence of stress tests, and I think this is one of the reason that our market is still quite resilient. It's not going to have any negative impact because what stress tests want to do is tools to making sure that the mortgage you signed up for or the home that you purchase, you have ability to pay in the future. We in the business, not just selling you a condominium, obviously we build it too, but most importantly, you have the ability to close it. So through the stress test too, like way back then, a lot of people are excited about the variable mortgage rate at 1.5%, but even back then, the mortgage stress test and making sure that you qualify for like 5.25 plus another 2. So therefore, you don't see too much of the power of sale or any delinquency that you actually was supposed to be happen during this rapid increase in interest. So to a certain point, we see a certain benefit of it too. But to Andy's point too, maybe it's about time for us to kind of review the rate. And then the basic function, we all agree, it's got like we're making sure that the home we sold, people be able to close and occupy it on it.
Excellent. Andy, you know, we've had this conversation time and time again on the relevancy of the stress test. Where are you? Where's your head these days with respect to what you think is going to happen?
I think Winson and I were discussing pre-show a great quote. I'm going to quote Winson on this, and maybe he can expand on it a bit. But you know, it's more important to close a sale than to sell a sale. And here it comes from the ultimate salesperson, right? But it's critical that we close the deal. So the stress test was brilliant in its time. In 2017-18, and we were going through strategic moves where rates were expected to increase at some point, and it was the right thing to do. Right now, it's piling on, though, and it's eliminating the first-time buyer from the equation. Over time, this will have a distortion within the marketplace. It's clearly, as we rebound here a little bit, I mean, Pauline showed you how low the sales activity is, but as we rebound, you need to take this test of stress off the consumer and allow that first-time buyer into the market to allow the normal process of the move up and move through a market or move down through a market, as the case as the consumer does. Right now, we're clogging the system. So although I get it, and I agree with Winson, it had been important, it's so important to close the sale, not just take the sale. I also think that the stress test has caused us to be more, I'm not saying it actually created the fraud component that we have within the market of mortgaging today. But clearly, in order to avoid that 2-point pylon, the consumer has been maneuvering around the fringes to try to get past it. And that's causing us some significant work with our tier 1 banks to make sure that all mortgage approvals and process are absolutely legitimate. But that's an interesting problem that we have that exists within the market that wasn't there before. So it's time it came off. I think it should come off now. It may not for a while, but that's my opinion on it at this time.
Thanks, Andy. So, you know, we all know of last year what we saw happen, right? The market declined. The MQR made homeownership that much more unattainable. So, Pauline, Winson, to each of you, maybe you can share examples to the best of what you're able to, with specifics, but what have we seen with respect to launches this, you know, in the last quarter with respect to pricing? Is there outside of the market, is the MQR factoring into decisions? And the second part of the question is, have we seen a shift away from thinking of purchase price away from end price and more on to carrying cost conversations, sort of like the way we used to maybe 2 decades ago?
Yonder time. I'll answer that first. It's like, I would say yes. Certainly when you see advertisements saying, you know, you're going to have a launch in, let's say for Hamilton, and you have product in the 300,000s. The biggest thing we saw like in Q1 is we had about 37% of our launched units sold during that quarter. So an absorption rate that was well down from like almost 90% a year ago, which was in itself a little bit abnormal itself. But pricing is flat. So price growth has primarily occurred a year ago. And since that time, even though it's up 5% year over year for an apartment, it hasn't moved very much.
Don't know.
So on that, sorry, just a little bit of a fuzz there. So on that front, I mean, townhouse products only up 3% year over year in pricing, but those figures kind of belie and also a factor of incentivization. And we've talked a lot about that. It's Zonda Urban recently. It's just, there's a lot of incentives out there right now, and you have to factor that into the price point. I mean, not every developer does them, but for a lot of the product that maybe sold or came to the market, you know, in the last 6 months, needs to get a little more absorption. They're looking at that product there, and that has to be kind of taken into consideration. So, you know, your cash backs, your credit closings, occasionally a rental guarantee, all have to be kind of thought about in front of that, on that number.
Winson.
Yeah, I echo what Pauline was saying too, and our view is the price become more realistic, both from the consumer side and from the builder as well too. And then obviously in this time of the uncertainty, different from the downturn before when we do with the financial crisis, people don't even want to talk to you about real estate. But right now, yes, they may not purchase right away, but then they get our realtor partner, take you from Hamilton to Mississauga, back to downtown, and still don't buy. So meaning that they have intention to buy and they're a little bit more cautious, and then they are a lot more informed. But for those of them that they anticipated the price to drop a lot, they was a little bit disappointed because quite honestly, all the developer right now, when we promote the price to, are all driven by cost. There is not too much adjustment in the cost side to still cost the same amount to build. So therefore, you don't really see too much of the adjustment on the price. In terms of people talk about the payment and all that too, to echo what Pauline was saying, that a lot of developers using various incentives to kind of speak to that too. And I should also add it to very important for us to include our partners such as CIPS or a major bank too, because they should be part of the solution too. Yes, right now we have a big stress test coming through. We have to deal with the policy, but should there be anything that they be able to navigate through? I was sharing some example with Andy before, and some of the challenge that I have from my Realty partner is, Tridel, you always get the mortgage approval. I can never get a mortgage approval from a bank, and then how could I help? How could we help? Interestingly, my simple solution is just arrange a meeting with the potential purchaser broker with the bank, because guess what? The purchaser did complain that the bank, it's very difficult giving us mortgage approval, have not actually approached a bank because they assume that our banking partner is very difficult. It's very difficult to get a mortgage approval. Who told you that? My cousin. I just leave it at that.
Right.
So let's shift over to the land side, Jeremiah. What's going on in the land business? Here we are, we go to the depths of depression a year ago. We're now entering recovery. We may be back to normal a year from now, but we haven't seen much land transactions occurring within the marketplace. Is this a kind of a reflection that land's 30 to 40% of the end equation of the selling price, and I'm going to hang in there and wait till this market uncertainty fully flushes out? Or is there opportunity now to buy in while we're in a tough market? What's going on out there on the land side as you see it?
Yeah, it's a great question, Andy. There's a lot of, I guess, misnomers or maybe some fallacies when it comes to the land market, but we all know that land is the very beginning process of what happens in the residential market when you need to build the condo or the subdivision. So, but if you follow along what's happened in Toronto's land market in the past, you look at high points of sales in the market, and you look at 2017 as being one of those. The land market is actually lagging typically 6 to 8 months after the high point in the sales market. So in 2017, we had $7.5 billion of development land sales across the GTA. over 700 transactions. This was the highest number to date for Toronto for number of transactions. That's because transaction dollar amounts were lower at that time. And then what happened is when the stress test came in, then you had that market drop by almost 40%. So the next year for development land, you had 4.9 billion. And then the year after, obviously, you still had a continue of a smaller market. It was 4.3 billion in land sales. So if you watch how the market, it follows along the residential sales market, and it typically lags 6 to 8 months. So the developers see that there is great demand for the market, and they begin their programs of buying acquisitions because they feel more comfortable that their exit, their revenue stream is more secure. So although right now, Andy, we're actually about 8 months into a correction for the land market. So in 2022, this was the highest dollar amount that Toronto has ever seen for development land, whereas 2017 was the highest amount of transactions. 2022 was almost $8 billion of development land. And so this is actually the highest grossing asset class in the market. Industrial was really only the second to that. And you could, I guess, couple industrial buildings and land, it would be significant over. So the point is, Toronto is a land market. Everyone lives, eats, breathes land. Like, it's very much an asset class. You don't see the same thing happening in different American markets, even Canadian markets. So with that said, you know, we have effectively Q3 of last year, the beginning stages of this correction. So we had about 40% off of highs, eventually hitting to a high of 60% off of highs. And I'm talking about dollar volume amount. I'm not talking about pricing, but pricing has shifted as well. So I can actually share my screen here and give a little example, but we have in the development land market, you have really a high point in the market where, there we go, where you can see that the market has shifted along to these points where there was greater sales. So you see 2017, the average dollar amount for, this is high-rise land specifically, was 101 buildable. And you have a big jump to 2018. And that happened because, as you know, Andy, the sales price for condos all of a sudden jumped. So as land is a residual number, it means that you work backwards from your revenue, and your land amount is ultimately what's left over after profits and costs from the revenue you see. So you see from 2017 to 2021, we had a significant shift. Now what happened in 2022, and we don't have the total amount of the data in 2023 yet, Q1, but it is going to continue to go down. And that's because, you know, effectively, you're looking at this market thinking, okay, how do we find the revenue stream that is proper to hit our residual number on land? So it's difficult to find that number when we don't have as much data from condo sales launches and low-rise division launches. So right now, we're still in this correction where we're off the market about 50% from highs. Again, I mentioned 2021 was $8 billion of land sales. 2022 was actually $7 billion of land sales. So still significant volume, but we're still trying to figure out where's that bottom, where is the time where we can figure out what the pricing is for land. So right now, to your point, Andy, we are a lagging indicator, and it will likely take, if this rebound in the condo sales market continues to happen, you will probably see Q1, Q2 of 2024, where the land market continues to move.
Is there a relationship between these market conditions of a motivated seller? Certainly there's many motivated buyers, but if I don't have to sell under stress, for example, in a market during its correction, then I don't have that. I don't put it on the market. And so you've got to have a willing buyer, a willing seller. But right now, is that fair to say that's not happening?
Yeah, that's not happening. And it's really good to look back in history and understand what happens when a market like this changes. And the best example in Toronto is in 2010 to 2016, what happened in the industrial land market. The great financial crisis in the US was directly affecting industrial properties in the GTA. And when that happened, you had dollar volume amount, number of transactions, and pricing hit a high in 2007. It continued to move sideways till about 2010. And then that market didn't rebound until 2016 for dollar volume, 2018 for number of transaction. So exactly to your point, Andy, we know that owners of land, if they don't have to sell and they're not going to get their pricing, they're not going to sell. Typically because owners of land, especially in Toronto, which is becoming very much a high density, non-ground related market for product, you're getting owners who have, say, a prior use for the property. They have a retail plaza, they have an office building, they have, I guess even kind of like industrial usage, which are being converted, and they have an existing use and it's a redevelopment parcel of land. So they don't need to sell. They have an operating business there. They have income coming in. They've just decided, hey, if my land was worth $50 million last year, today it's worth about $40 million. Do I have to sell? No. Do I want to sell? Maybe, but maybe I'll just wait a little bit. So we're seeing that correction in the market. The dollar volume is down significantly and the revenue is down. I'm not even going to go into the amount of development levy fees that have been increased by the city, the debt costs that have been increased by construction. Developers can't pay as much as they could last year, right? So we're going to see probably a continuance of this decrease in volume until things change on the revenue side or say the soft costs in the construction side.
Does this affect the perspective of moving between purpose-built rental and condo and a piece of land? Absolutely.
Like, we have had a significant amount of interest for purpose-built rental. It's mostly because developers rather, and investors are starting to realize, there is a market in purpose-built rental because of our rents moving significantly. So last year, and I'm sure Pauline can tell you better data than me, but from what I know, there was a 13% increase year over year on rents. It's pretty significant, and that market's continuing to move. So purpose-built rental is becoming an attractive offer because that revenue side is starting to make sense because the land market has gone down, the revenue has increased, and there's programs like the CMHC MLI Select program, which are allowing for lower leverage. So, and traditionally, just to give the audience a sense, people have chosen condo development over rental because condo development has a lower equity requirement. You were able to pre-sell the condos, which obviously Andy is the master of here. And once you get that revenue in, you can then use those deposits as a form of equity, right? So they're bonded, they're protected, but then you're using that as a form of equity. So the amount of cash into the project is less. And then that means the ultimate return that you get can be higher. And then on top of that, the rents, if you say take a $4 rent, it's comparative to roughly $950 to $1,000 a square foot on the condo revenue side. Whereas that same location could have had $1,300, $1,400 a square foot condo revenue, right? So those two revenue sides have traditionally been very spread, and that's why people are doing condo, less equity, higher revenue. Now those spreads are beginning to diminish, and people are starting to realize, wait a second, there's less land out there. Maybe I want to hold on to this building and hold this location for the long term. I'm okay with the lower revenue. I'm okay with the lower return. I'm going to use CMHC program, which is a wonderful program by the government. And I'm going to build something out that will stay here for the long term.
Thanks, Jeremiah. Those are tremendous insights. I really appreciate it. Over to you, Chris.
Yeah, Jeremiah, I know we want to keep going and talk a little bit about how there's maybe some alternate sources of land availability. And Andy, we'll chat with you about that in a minute. But I want to come back to Pauline and to Winson for a second. And go back to the MQR and the impact on the front line, the home buyer today. We know that some Canadians have been Winson, we know some Canadians have been turning to some of those alternative lenders that don't require the stress test, but they're charging, significantly higher rates. Are you seeing any examples of developer programs aside from the rate buy downs that are designed to help home buyers that are, starting to have some traction out there that you've seen?
Well, I think Pauline kind of talked about some of the incentive that you see already in the market, like, obviously interest buy down, and some of the developer even pay for the entire year's mortgage, maintenance fee and whatnot. But then don't forget, it's all our pricing, it's all cost approach. It still come from a certain revenue sources too. Say if you cost X amounts, we need to sell for that amount. We always focus on like a true value, true pricing. What is the real pricing that you are actually paying to? In terms of the alternative lending too, yes, obviously, especially when they go to the very last minute, I see a lot of shift into the alternative lending. But going back to my comment before too, if you kind of proactively handle your finance ahead of time, work with your banking partner, work with your mortgage specialist, financial advisor too, you don't really need to go into the last minute side of it too. There is a lot of program out there. There is a lot of specialized program from the bank. And I see the bank is also now very proactive, reaching out to the consumer and the bankers too, so that they be able to show them all this different solution. Just like stress tests shouldn't be just like one step solution. So involve your realtor, involve your banking partner. I'm sure that collectively we can navigate that too. But the real problem of the challenge that we're talking about is not quite the stress test. It's still what Andy alluded to before, is the supply issue. We just still not have enough homes for the imminent demand. So therefore, the price pressure is still continuing.
And the price pressures still continue, exactly. Pauline, we heard about that somewhat new now federal first-time home buyers savings program. Does this have any legs? Is this a way to maybe address some of these challenges struggled by today's first-time home buyers?
I think that it's a very limited stopgap. I mean, I think it's anything to actually help you kind of mitigate your taxing and save is not a bad thing. But it only addresses like the demand side, and Winston's right. The supply side is where it's problematic. So, if you're out there and your rents are increasing, and you're sharing a unit, and all those other inflationary factors that have come into place, how are you actually still saving to get into that plan ultimately at the end of the day? And there's no choice out there, so you're not adding to that. I mean, we're seeing on our end. I mean, starts have plummeted in Q1 for us for apartments. And we're starting to see a slowdown in the early stages, like excavations dropped like almost 40% in the last 6 months in terms of the numbers that are actually there. So that's your pipeline that's going through the construction area, and they're not going to be there, 4 years down the road for those units. So,
Andy, over to you.
Well, it's our political class loves the demand side. It's easy, politically friendly. I can help the consumer, and it's the wrong way to go. It's almost, I'd almost like to wipe the slate clean. Let's pull all that demand push assistance off the table and pour our energies and our financial capability into supply. It's so critical at the moment. You wonder for just a moment of $13 billion spent on one battery plant in St. Thomas. Great investment. But what about $13 billion spent on infrastructure, sewer, water, roads, transit? The necessary suburban elements, particularly in 905, that can increase supply dramatically. Let me throw it over to Jeremiah for a minute on office conversion. If half the people aren't still going to work, they're working from home. If that's still the case, I've seen it in New York recently where 2 conversions are now underway of office towers that are being converted to condo. Is that an unhidden something or a hidden opportunity that we can latch onto of converting empty office space to residential accommodation? Jeremiah?
So for the record, Andy, I'm in the office every day. So is my team. You got to support the industry here. Yeah, listen, the answer is not really. No, like there is a significant amount of product that could be converted, but what has happened in Toronto is over the years, because our residential demand has been significant, there was official plan amendment to protect employment uses, specifically office. So right now, any office building that you have in certain areas of the city, once it's torn down to create residential, you have to replace that same office. So I am slightly optimistic that the city's starting to understand that there is, a substantial decrease in office demand. Right now, Colliers is tracking the office vacancy rate in the high 13%. That's because we include government buildings as well. If you take out those government building vacancies, the actual vacancy rate could be as high as 18, 19%. So, and we might actually bottom closer to 20%. So there is a substantial shift. It's a paradigm shift of working towards hybrid. So companies are, looking to change that. But as it relates to office conversion, number one, you have to buy the office at an accretive number in order to make sense of this, because it's going to cost you roughly, from what my development team is telling me, upwards of $300 a square foot for a conversion. And so right now, those numbers don't really make sense. And the only examples we have of this so far is at the corner of Dundas and University. There was a developer who actually continued to use his office and built a residential condo above the office using a pretty sophisticated infrastructure on external infrastructure outside of the building. And right now there's another major developer at 200 University and Richmond, who is also proposing this, GWL rather, to build a residential tower above an office building. So right now, Andy, the answer to the question is not really. There's not enough conversions to make sense of it. Office building typically have a floor plate that is very large. So in order to convert to residential floor plate that's efficient and not too expensive for the end buyer, as you would know all about, it's hard to find those type of office buildings. But there are a number of, call it 70s to 90s era office buildings that do have smaller floor plates. They would be prime conversion candidates. But the question is, will the city allow, I'm talking about Toronto specifically, because other areas like Montreal, Vancouver do have different policies here, but you have to have the municipality allow you to convert these to residential without asking for a conversion or a rather a protection of the current office space. So I believe that this is going to, continue to shift. I know that the city is studying this. We would hope that they consider this in certain aspects, but right now it's not really going to change the supply metric that much.
I noted that Pierre Poilievre promised the other day 37,000 federal offices, buildings owned across the country, of which he committed to converting 15% to housing. But it may be a massive challenge to be able to do that, other than those that might be older retrofit types of situations that could be actually possible. But it's a numbers exercise, just like the exercise you'll go through from ground zero of a raw piece of land to convert a existing office tower is going to be an extra added cost, not necessarily a savings cost, unless the building is a federal building that's contributed for next to nothing in terms of the overall land component part. Anyway, an interesting thought. I pass that on.
And I would just add, we have an internal development team, and they are looking at this in Calgary. Calgary seems to be the only market where there is the potential to do these conversions, again, dependent upon what the value of the office building is. But if you can get an office building in the range of $100 a square foot, then your conversion costs can actually make sense, even in a market like Calgary. So hopefully we see it first in Calgary, but it's not necessarily something that's commonplace yet. Going to be, rather.
Thanks, Jeremiah. Chris?
I'm watching the clock, and we're coming up to the close soon. So I'm going to flip the program to some rapid fire questions to the panelists. So again, thanks panelists for a great discussion so far. There's also the audience out there. So in the audience, if you have questions, please post them in the Q&A, and I'll try and include them in some of the rapid fire. So anyone, what is the impact on projects right now in the market that are just shy of the sale test, that are still actively pre-construction selling? What are the impacts of MQR on those projects that are just close to getting over the line to get started?
I'll take a shot. I would say very, very lucrative, or not, I don't think lucrative is the right word. I think a very kind terms on deposit structures is the biggest thing I've seen. And when we talk about the incentives, but it's also the deposits and actually being able to put down that kind of 15 to 20% to get them over the line at this point. So being more generous on that end is the biggest thing. So,
anyone else?
Yeah, I think under the current circumstances, there's imminent shift from the tenant to the home ownership as well too. We commented 1 bedroom averaging rents $2,500 to like $3,000 a month. If you use simple math, $2,500 a month times 12 times 25, you're paying the landlord $750,000. So I think there's a lot of product offer below that range. And then to Pauline's point too, because of the tenant that don't have enough money to kind of save for the deposit too, the extended deposit structure will definitely help the future home ownership.
I just also add to that, I think there's going to be a cascading shift of developers deciding not to do residential if they don't believe they can hit their pricing, and converting to a rental product. Because if you look at it right now, the average mortgage costs are $4,200 a month, whereas the average rent in the market is around $2,600. So I think you're just going to have a shift of that product. And I already know a number of developers who are looking to shift their pricing of their launch numbers significantly down from where they originally had underwritten the property, just to be able to get that sales velocity. So I think it's going to change the whole supply side.
Yeah, very interesting. We've got a hangover of inventory in the market of product that is now built and occupied, or mostly occupied, and there's a significant hangover of number of units that are unsold in any one building. Now, it's generally a small percentage per building, but you look at the overall, it's quite an interesting number, and how to clean that up is going to be an exercise and adjustment to a market place. Now, there's lots of room because of the lift has been significant, but it's going to be a challenge. And then Pauline, I forget the total number, but I think it's something like 37,000 units that we're about to close this year. It's a big number that will close this year. No issue on closing for the most part, again, because the lift has been significant from something sold 4 and 5 years ago. But there may be some impact there from inventory that, for the stress test and other financial consideration, has some challenging closing issues. We don't expect it to be a big deal, but it's going to be a one-on-one situation between the lender, the developer, and the consumer to figure out how to make sure this stuff all closes.
That's a really good point, Andy. This is maybe Pauline and Winson. This is a question more for you, but in this, where we know we're coming on to record closings and completions on the horizon. What does the assignment market look like today? That shadow assignment market, has that changed the dynamic?
I don't know if it's changed the dynamic. It's certainly grown in scope. It's a little more stressed from what we can see out there. I mean, there's very few, like we've talked about this a little bit before, but like just quantifying the numbers are out there, because a lot of it tends to be the same projects that or listings that are in multiple places. So, but I've definitely seen a lot more, distressed sales out there along that. And it becomes a game of margins, really. Like if there's more of those out there, they become a little more like noticeable on the end. That's just something to think about. I mean, there's about, to go back to the numbers, about 25,000 this year, and an insane number. I'm not going to say it's 38. It's not going to be 38 next year, but it'll probably be high 20s next year in terms of deliverables. So that'll just kind of be a little more of a prevalent out there to be able to see in the marketplace. So.
Yeah, for us, I cannot speak for other developer, but we actually don't see as much as the stress because of the stress test. And before the seminar, we kind of chit chat with Andy too. One of the challenge for the broker to work with Tridel usually is, do not buy from Tridel because they ask for mortgage approval. And because of the hard work before, we really diligently managing the mortgage approval. We honestly don't feel too much of the stress per se, but I do understand. But if we don't actually proactive check out the stress test and ask for mortgage approval, we may have the fair share of challenge. But I'm happy to report it for the past a year, like we close over 2,000 homes. We don't have any significant challenge.
So I'm going to talk about new normal a little bit. In a world, and I'm going to throw this out, Andy, you included, in a world where the MQR doesn't go away, what does the new normal look like?
Wow.
Well, I think it puts a damper on absorption overall, and that's literally locks the first-time buyer out of the marketplace today. The investors returned, the equity mover has returned, the move down market is reasonable. Those things will see some growth, but the first-time buyer will be continually restricted from access. And that is not a positive element to the normal transaction of business in our real estate world. So at some point, it has to come off in order to get back to what we might call normal. I'm not sure what normal is anymore. So there you go. But a year from now, I envision a market with no stress test and much more buoyant absorption and a corresponding increase in supply, at least of what's being offered on the market, not necessarily yet under construction, but quite a different scene a year from now. And Toronto is one of the great cities of the world today. One of the cornerstones of that is our tech industry, which has been quite remarkable. And I've talked about this before, but there's 36 hubs of technological improvement out there, 75,000 jobs. Their average incomes are 120 a year. This is an enormous positive element for this city. And going forward, that sense of immigration, you've still got this pipe pouring into this city in terms of people. It behooves all of our political leadership and the industry, of course, strongly on the supply side. We've got to move that needle. If we don't, you're going to see another spike in prices like we have experienced historically, because the demand push just doesn't stop.
For the last year or so, we've on this program in meetings at the office, we talk about the signal, right? We're looking out for that signal or sign in the market that is that opens we're crossing that threshold with that signal. Connected to OFSI, like, what do you believe they need in a signal, or what is it they need to adjust or eliminate or pause the stress test? Like, what is it that what do you believe OFSI needs? What do they require? Anyway, I won't put anybody on the spot.
Yeah, I think it should not be just a one type of solution. Like the stress test is only one formula, and I think moving forward, I think they need to be a little bit more flexible in terms of the first-time buy, if they have a certain equity, and then if they have a certain credit or lending habit, be able to have some exception on modification to the stress test. And I think I would see it like at what Andy was saying too, that they 100% need some modification. It may not be the stress test, so how about the amortization? Would the amortization will be a little bit longer too? Again, like all this, I don't think that will provide a solution. The solution is still going back to many series that we talk about is the supply. Like we do not have enough supply for the imminent demand. The direction can only go one way.
There you have it. I think we're going to wrap it up at this point. I'd like to thank everyone on the panel for great ideas, insights. This is not an issue that's going to go away in the short term. It is today's normal, and we as an industry are rallying together to do the best that we can to offer value to our clients and great service, and ultimately put roofs over people's heads, right? So now, Andy, I think you're doing the draw today. So go ahead, and then I'll wrap it up.
How great is that? There you go. So thank you, CIBC, for the free lunch. Who says there's no free lunch? There is one here at the CIBC Summit. And the first winner, is John Overset. Congratulations, John. And, there's a man who's gone through every rise and fall in this market. He should be a panelist. And the second winner is Paul Joshua.
Congratulations, Paul.
Tanda Corp, is that correct? Paul Joshua. Thank you, Paul. How many do I do, Chris?
I think we're at it. There you have it.
Two free lunches. Okay, great.
If you're interested in getting involved in our program, becoming a sponsor, or being on one of our panels, please reach out to me. I can be reached at 905-415-2720. A special thank you to our event producer, McCoot Partnership. Everyone have a great afternoon. Thank you for joining us. Have a great weekend ahead, and we'll see you in about 3-4 weeks for our next session toward the end of May. Thanks again.
Thanks, everyone.
Thank you. Bye-bye.